Hey everyone, welcome to Alpha Insights. I'm Sarah.
And I'm Ryan. Great to have you with us.
And hey, if you have questions while you're listening, drop them at stockalpha.ai.
Yeah, that site is where we'll be answering your Q&A later.
So let's jump in. The big thread we're unpacking today is this mismatch between what the broad market is pricing and what's actually happening on the ground.
Right. To put it plainly, markets are baking in a calm, soft landing world. But energy and defense markets are pricing a very different reality.
And quick note, U.S. markets are closed today. It's Sunday. So when we talk prices or valuations, we mean as of Friday, April 10th. Important distinction.
Exactly. For example, as of Friday, April 10, the S&P 500 was still trading with a forward price to earnings above its long-term average. Analysts say that implies a comfort premium the macro picture doesn't really support.
The problem is a list of missing things the market is assuming. Disinflation, lower rates, smooth supply chains, stable geopolitics. None of those are guaranteed right now.
And on geopolitics, the single most important choke point is the Strait of Hormuz. This is not abstract. Roughly 20% of the world's oil and 20% of global liquefied natural gas transits there.
The image that popped into my head was, you pinch that spot and the whole system starts seizing up.
Yeah, that's a good point. A 30-day blockade is not a headline. It's a synchronized supply shock across fuel, freight, food, chemicals, fertilizer, everything that runs on oil.
Which means pump prices can reprice in days, supply chain costs reprice in weeks, and full inflationary pass-through shows up in months. The Federal Reserve can't just reverse that without breaking something else.
The Energy Information Administration projected Brent at about $103 a barrel on average in March, with a peak near $115 a barrel in the second quarter of 2026. And that's before any serious Hormuz disruption.
Goldman has scenarios pushing Brent back above $115 a barrel. Barclays warns that delays restoring flows could blow past those numbers. Those are analysts, not opinions.
And the people who get hurt first are not hedge funds. It's the American who drives 45 minutes each way to a job that doesn't pay enough. The family buying groceries on a tight budget. The household trying to manage credit card debt at about 22% APR.
Honestly, I was a bit surprised by how fast those downstream costs move. 2 to 3 weeks of extra shipping around the Cape of Good Hope, and you've added hundreds of dollars per voyage. Those costs don't vanish.
They migrate downstream to refiners, distributors, truckers, and eventually, the family filling up a minivan. It's basic economics.
Now, another dimension here is the diplomatic side. The Peace Be Read argues the negotiating team has shown a worrying lack of basic supply chain and economic literacy.
I mean, when you look at shipping timelines and rate of change inflation, they matter. You don't paper over a physical commodity disruption with press statements after markets close.
Exactly. And there's also been talk of invoking NATO. People keep throwing around Article 5, which is collective defense, but they're missing Article 6, which limits that coverage to Europe and North America.
Calling for NATO to step into the Middle East shows a lack of basic treaty literacy. It's legally and politically incoherent. And European allies are already dealing with their own energy and security headaches.
Short reactions.
Right.
Interesting.
A lot of heads-up thinking missing.
There's also that difficult, sensitive line about influence and leverage. Questions some analysts are asking about long-running influence operations and whether those exposures affect policy choices. These are open, serious accountability questions, and they deserve scrutiny, not slogans.
Agreed. The point isn't conspiracy. It's that when policy outcomes consistently diverge from identifiable national interest, we should ask why and follow the evidence.
Okay, market implications. Strip the politics away, and here's what the market has been signaling. Energy is pricing scarcity, and defense is signaling a multi-year reallocation of capital.
Analysts note Europe and other NATO members increased defense budgets sharply, and global military spending hit record levels. That creates durable demand for missile systems, munitions, drones, sensors, battlefield software, and logistics.
Airlines, on the other hand, are a trap. Jet fuel is a huge chunk of costs. IATA projects fuel around 25.7% of airline operating expenses this year. And when geopolitics spikes fuel, airlines get whipsawed.
Exactly. So analysts call energy and defense structural themes in this environment, while airlines look tactical and volatile.
Quick reminder, we're not here to tell you to buy or sell anything. This is market analysis and context for informational purposes only.
Right. Last bit. Accountability. The piece lays responsibility at two seats, the White House and the Israeli Prime Minister's office. Whether you agree or not, the takeaway for markets is the same. Policy choices matter, and they can reprice the economy fast.
So, key takeaways. Want to run them together?
Yeah, ready.
First, broad market valuations looked optimistic as of Friday, April 10, and that optimism depends on a world that isn't guaranteed.
Second, the real economic vulnerability is a physical one, the Strait of Hormuz, where disruption can spark rapid inflation and real pain for Main Street.
Third, energy and defense markets are pricing that reality. Airlines are being tossed around by oil moves and look more tactical than structural.
Totally. And again, this is analysis, not advice. Analysts note these are the themes showing up in prices.
All right, that's our wrap. Got questions? We'd love to hear from you. Head over to stockalpha.ai, where you can ask us anything, and we'll answer live.
And while you're there, check out more market content and drop your cues for our next episode. Thanks for listening.